Hello everyone, welcome to the 39th episode of me learning how to trade using Forex. So in the last video we went through this page right here, which is types of Forex orders. So we made some notes across this page, we got to this bit here, read all this, made the notes up to here, and now we're currently doing trading orders types cheat sheet. So I think we did get to parts of here, but we stopped because we were running out of time. So we're gonna just start from the beginning again, just reread through everything, and then make some more notes. So let's get started. Trading orders type cheat sheet. When trading Forex or other financial instruments, it is crucial to understand the various order types available to execute trades. These order types provide you with the flexibility and control needed to execute your trading strategies effectively. In this lesson, let's review the most common order types you learned from the previous lesson, their functionality and the advantages and disadvantages of each. Market order. A market order is a type of trading order that is executed immediately at the current market price. This order type ensures that the trade is executed quickly, which can be crucial in fast-moving market. Market order executed at current price. Advantages include fast execution, high probability of trade execution. Disadvantages: no control of the execution price, potential slippage, which is what we made. Okay, so next one is limit order. A limit order is an order to buy or sell at a specific price or better. Order to buy or sell at a specific price or better. This type of order provides you with control over the price at which the trade is executed. So it provides you with control over the price at which the trade is executed. Advantages: control over execution price, no slippage. Advantages: control over execution price, no slippage. Disadvantages: execution not guaranteed, may require patience. Execution not guaranteed, may require patience. Advantages include, disadvantages include stop order. A stop order, also known as a stop loss order, is an order to buy or sell something, or buy or sell once the price reaches a specified level. So order to buy or sell at a once the price reaches a specified level, at a specific price, known as a stop price. Known as the stop price. Order to buy or sell at a specific price or better. This type of order can help protect you from large losses. Protects you from large losses by automatically exiting a position if the market moves against you. Advantages. Advantages include risk management, automatic trade execution. Disadvantages include no control over execution price, control over execution price, and potential slippage. Stop limit order. A stopped limit order combines the features of a stop order and the limit order. Combines the features of a stop order and a limit order. Once a stop price is reached, the order becomes a limit order to buy or sell at the specified price, limit price or better. Once the stop price is reached, the order becomes a limit order to buy or sell at the specified price or better. Once the stop price is reached, the order becomes a limit order to buy or sell at a specific price or better. Advantages include combines risk management with price control. Combines risk management with price control. Potential for better execution price. Potential for better execution price. Disadvantages include execution not guaranteed and more complex to set up. Trailing stop order. Trailing stop order. So trailing stop order is a type of stop order that moves with the market price. Type of stop order which moves with the market price. It allows you to lock in profits as the market moves in your favor while still providing protection if the market reverses. Allows you to profit whilst the market is in your favor and also protecting you if the market reverses. Advantages include dynamic risk management. Locks in profits. Disadvantages include no control over execution price, potential slippage. Good till cancel order. Good till cancel. A good till cancelled order is an order that remains active in the market until you cancel it manually or it is filled. An order which remains active in the market until you manually cancel it or it's been fulfilled. Good till cancel orders can be used for various types of orders, such as limit and stop orders. So can be used with various types of orders, such as limit and stop orders. Advantages include time efficient, flexible. Advantages include time efficient, flexible. Disadvantages include risk of forgetfulness, requires monitoring. Risk of forgetfulness and needs monitoring, doesn't it? Requires monitoring. One cancels other order. Cancels. A one cancels order, however, consists of two orders, typically a limit order and a stop order. Consists of two orders. Typically a limit order and a stop order. If one order is executed, the other is automatically cancelled. If one order is executed, the other is automatically cancelled. Advantages include simultaneous management of multiple orders. Simultaneous management of multiple orders reduces risk. Disadvantages include forgetfulness is one of them, right? More complex to set up. Oh no, never mind. Oh no, because you can't forget this because you're meant to cancel it manually. So more complex to set up. Execution of only one order. Execution of only one order. Summary. Understanding the various order types available for trading is essential for executing your trade strategy effectively. Each order type offers its own set of advantages and disadvantages. By familiarizing yourself with these order types, you can gain better control over your trades and improve your overall trading performance. So if I do summarize this, I think I'm probably going to make a table. So for example, like all the advantages and disadvantages over here. So advantage, what advantages? Risk management, and then have the limit order, stop order, market order down like this column, or this column, and have the criteria's advantages and disadvantages in the row, and then just do like tick boxes on matching the advantage disadvantage to the actual order type. So probably going to do that in the future. Yeah, okay. Demo trade your way to success. You can open a demo account for free with most Forex brokers. These pretend accounts have most of the capabilities of a real account. But why is it free? It's because the broker wants you to learn the ins and outs of their trading platform and have a good time trading without risk, so you fall in love with them and deposit real money. The demo account allows you to learn about the mechanics of Forex trading and test your trading skills and processes with zero risk. Yes, that's right, zero. You should demo trade until you develop a solid, profitable system before you even think about putting real money on the line. We repeat, you should demo trade until you develop a solid, profitable system before you even think about putting real money on the line. We should demo trade, don't lose your money declaration. Now place your hand on your heart and say, I will demo trade until I develop a solid profitable system before I trade with real money. Now touch your head with your index fingers and say, I am a smart and patient Forex trader. Do not open a live trading account until you are consistently trading profitably on a demo account. Open account until you are consistently trading profitably on a demo account. If you can't wait until you're profitable on a demo account, then there's very little chance you'll be profitable live when real money emotions are factored in. You're probably thinking, so what I hear you saying is there still a chance then? Facepalm. If you're that impatient, then at least try to demo trade for at least a month. You can hold off losing all your money for a month, right? If you can't, just donate the money to your favourite charity or give it to your mama. Show her that you still care. Even after reading this, you're probably still not going to go for a demo trade for at least a month since you're stubborn like that. But at least we tried. Concentrate on one major currency pair. It's far too complicated to keep tabs on more than one currency pair when you first start demo trading. Stick with one of the majors because they are the most liquid, which usually means tighter spreads and less chance of slippage. Plus, in the beginning, you need time to focus on improving your trade process and creating good habits. You will also need to... Alright, so let me just say... concentrate on one major currency pair. Plus, in the beginning, you need time to focus on improving your trading process and creating good habits. In the beginning, focus on improving your trading process and creating good habits. You will also need to experience different market environments and learn how to adjust your methods and strategies as market behavior changes. Need to experience different market conditions and learn how to adjust your methods and strategies as the market behavior changes. You can be a winner at currency trading, but as with all aspects of life, it will take hard work, dedication, a little luck, and a whole lot of patience and good judgment. Next lesson, can you get rich by trading Forex? Before we go any further, we're going to be 100% honest with you and tell you the following before you consider trading currencies. 1. All Forex traders, and we do mean all traders, lose money on some trades. 90% of traders lose money largely due to a lack of planning, training, discipline, and not having a trading edge, and having poor money management rules. If you hate to lose or are a super perfectionist, you'll also probably have a hard time adjusting to trading, because all traders lose a trade at some point or another. Trading Forex is not for the unemployed. Those on low incomes are knee-deep in credit card debt, or who can't afford to pay their electricity bill or afford to eat. You should have at least $10,000 of trading capital in a mini account that you can afford to lose. Don't expect to start an account with a few $100s and expect to become a gazillionaire. The Forex market is one of the most popular markets for speculation due to its enormous size, liquidity, and the tendency for more currencies to move in strong trends. You would think traders all over the world would make a killing, but success has been limited to a very small percentage of traders. The problem is that many traders come with the misguided hope of making gazillion bucks, but in reality they lack the discipline required for really learning the art of trading. Most people usually lack the discipline to stick to a diet or go to the gym 3 times a week. If you can't even do that, how do you think you're going to succeed in one of the most difficult but financially rewarding endeavors known to man and woman? Most difficult but financially rewarding. Short-term trading is not for amateurs, and it is rarely the path to get rich quick. You can't make a gigantic profits without taking gigantic risks. A trading strategy that involves taking a massive degree of risk means suffering inconsistent trading performance and large losses. A trader who does this probably doesn't even have a trading strategy unless you call gambling a trading strategy. Forex trading is not a get-rich-quick scheme. Forex trading is a skill that takes time to learn. Skilled traders can and do make money in this field. However, like any other occupational career, success doesn't just happen overnight. Forex trading isn't a piece of cake, as some people would like you to believe. Think about it, if it was, everyone trading would already be millionaires. The truth is that even expert traders with years of experience still encounter periodic losses. Drill this into your head, there are no shortcuts to Forex trading. It takes lots and lots of practice and experience to master. There is no substitute for hard work, deliberate practice and diligence. Patience trading on a demo account until you find a method that you know inside and out and can comfortably execute objectively. Basically find the way that works for you. There is no substitute for hard work, deliberate practice and diligence. Forex trading sessions. Now that you know what Forex is, why you should trade it, and who makes up the Forex market, it's about time you learn when you can trade. It's time to learn about different Forex trading sessions. Yes, it is true that the Forex market is open 24 hours a day, but that doesn't mean it's always active the entire day. You can make money trading when the market moves up, and you can even make money when the market moves down. But you will have a very difficult time trying to make money when the market doesn't move at all. And believe us, there will be times when the market is as still as the victims of Medusa. Tokyo session. This lesson will determine when the best times of the day are to trade. Forex market hours. Before looking at the best times to trade, we must look at what a 24-hour day in the Forex world looks like. The Forex market can be broken up into 4 major trading sessions: the Sydney session, the Tokyo session, the London session, and Trump's favourite time to tweet before he was banned, the New York session. Historically, the Forex market has 3 peak trading sessions. Right, okay, so the Forex market can be broken up into 4 major trading sessions. The Sydney session, the Tokyo session, the London session, the New York session. Historically, the Forex market has 3 peak trading sessions. Forex market has 3 peak trading sessions. Traders often focus on one of the 3 trading periods rather than attempt to trade the market 24 hours per day. This is known as the Forex 3-session system. These sessions consist of the Asian, European and North American sessions, which are also called Tokyo, London and New York sessions. Some traders prefer to differentiate sessions by names of the continent, other traders prefer to use the names of the cities. We prefer using city names, but continents are cool also. Forex 3-session system. Sydney. Did you know the combined share of the top 4 trading centres, which includes London, New York, Singapore and Hong Kong, amounts to 75% of global Forex turnover? The international date... What have I... Where's 3 peak trading sessions? Forex 3 session then. Known as the Forex 3-session system. This consists of the Asian, European and North America sessions, also called Tokyo, London and New York. The international dateline is where by tradition the new calendar day starts. The international dateline is where by new condition. Since New Zealand is a major financial centre, the Forex market has opened there on a Monday morning, while it is still Saturday in most of the Sunday in most of the world. Even though trading starts in New Zealand, it's still called the Sydney session. Makes no sense, but we don't make the rules. Until Friday, there is no time during the week when the market formally closes, although there is a brief lull in activity between about 1900 and 2200 GMT, where most American traders have gone home and most Kiwi and Aussie traders are getting ready for work. Other than the weekends, there are just two public holidays when the entire Forex market is closed: Christmas and New Year's Day. Below are the tables of the open and close times for each session. Local time: Sydney open 7 AM, Sydney close 4 PM. Eastern time UTC: Tokyo open, Tokyo close. London open, London close. So London opens at 8, closes at 5. New York opens at 8, closes at 5, 9, 6, 7, 4, 2 AM, 11 AM. Actual open and closing times are based on local business hours, with most business hours starting somewhere between 7 to 9 AM local time. Daylight saving times. Open and close times will also vary during the months of October and November and March and April, with some countries, like the United States, United Kingdom and Australia, shift to from daylight savings time. The days of the month that a country shifts to from daylight saving time also varies, confusing us even more. And Japan doesn't observe daylight savings, so thank you Japan for keeping it simple. Now you're probably looking at the Sydney Open and wondering why it shifts 2 hours in the Eastern time zone. You would think that the Sydney Open would only move 1 hour when the US adjusts for standard time, but remember that when the US shifts 1 hour back, Sydney actually moves forward by an hour. Seasons are opposite in Australia. Keep this in mind if you ever plan to trade during that time period. Dealing with the daylight saving times is a pain, but that's what happens when the market trades around the clock. It's important to remember that the Forex market opening hours will change in March, April, October and November as countries move to daylight saving times on different days. Important to remember that the Forex market opening hours will change in March, April, October and November as countries move to daylight saving times on different days. If you're still confused, no worries, we built a Forex market hours tool that will automatically convert all 4 trading sessions in your local time zone. Use it as a reference until you remember the market hours from memory. Ooh, that's very good. Trading session overlaps. Also take notice that in between each Forex trading session there is a period of time where 2 sessions are open at the same time. For example, during the summer from 3 to 4 AM ET, the Tokyo session and London session overlap, and during both summer and winter from 8 AM to 12 PM ET, the London session and New York sessions overlap. Naturally, these are the busiest times during the trading day because there is more volume when 2 markets are open at the same time. This makes sense because during those times all the market participants are wheeling and dealing, which means that more money is transferring hands. Busiest. During the trading day is when two sessions overlap. Now let's take a look at the average pip movement of the major currency pairs during each Forex trading session. So London is the highest then. Looks like JPY. From the table you'll see that London session normally provides the most movement. Notice how some currency pairs have much larger pip movements than the others. So GBP slash JPY, very high pip movement. High. London. To see the average pip movement for a specific currency pairs in real time, you can use our market milk tool. For example, here's the volatility per hour for Euro USD filtered by London and New York sessions. Volatility per hour. Let's take so London, New York, average 13 pips. So the average of these is 13. From last 7 days, 16 hours. Okay. Let's take a more in-depth look at each of the sessions, as well as those periods when the sessions overlap. When can you trade Forex? Tokyo session. For traders living in America, the trading day actually begins on Sunday night at 5 PM Eastern Time, 10 PM GMT, Greenwich Mean Time. However, liquidity doesn't really show up until Tokyo opens a few hours later. The opening of the Tokyo sessions at 12 AM GMT marks the start of currency trading in Asia. You should take note that the Tokyo session is sometimes referred to as the Asian session. We built a Forex market hours tool that will automatically convert all 4 trading sessions in your local time zone. Use it as a reference until you remember the market hours from memory. One thing worth noting is that Japan is the 3rd largest Forex trading center in the world. This shouldn't be too surprising since the yen is the 3rd most traded currency, partaking in 16.8% of all Forex transactions. Overall, around 20% of all Forex trading volume takes place during the Asian session. It's not all coming from just Tokyo though, there are other major financial centers in Asia such as Singapore and Hong Kong. What's interesting is that nowadays more Forex trading volume comes out of Singapore and Hong Kong than Tokyo. Both Singapore and Hong Kong comprise 7.6% of overall volume each, whilst Japan had 4.5%. Maybe Asian session is more appropriate than the Tokyo session. Below is a table of the Asian session pip ranges of the major currency pairs. Or there's nothing here for Euro CHF though. I wonder why. These pip values were calculated using the averages of past data. Take note that these are not absolute values and can vary depending on liquidity and other market conditions. Pip ranges. Also, the session ranges for Euro CHF has not been included since the Swiss franc has been pegged to the euro at 1.2000 during the period. An easy way to find out the current average pip range for a currency pair during the Tokyo session is to use our Market Milk app. For example, here's the average pip movement for Euro USD. I think we just have not seen actually. For Tokyo Euro USD, oh no, that's the range. This is the pip range, average pip range. So what was that 56? Yeah, I'm not sure about this one. What's... There's no labels on the axes. There's a random 4 here. What does that mean? Average of... Yeah, I don't really know about this graph here. Here are some key characteristics that you should know about the Tokyo session. Action isn't only limited to Japanese shores. Tons of Forex transactions are made in other financial hotspots like Hong Kong, Singapore and Sydney. The main market participants during the Tokyo sessions are commercial companies, exporters and central banks. Remember, Japan's economy is heavily exporter dependent, and with China also being a major trade player, there are lots of transactions taking place on a daily basis. China also being a major trade player. Liquidity can sometimes be very thin. There will be times when trading during this period will likely be like fishing. You might have to wait long time before getting a nibble. It's more likely that you'll see stronger moves in Asia-Pacific currency pairs like the AUD-USD and the NZD-USD, as opposed to non-Asian Pacific pairs like GBP/USD. During those times of thin liquidity, most pairs may stick within a range. This provides opportunities for short-term day traders or potential breakout trades later in the day. Most of the action takes place early in the session when more economic data is released. Moves in the Tokyo session could set the tone for the rest of the day. Traders in the latter sessions will look at what happened during the Tokyo sessions to help organize and evaluate what strategies to take in other sessions. Typically, after big moves in the preceding New York session, you may see consolidation during the Tokyo session. Right, okay, so, Tokyo session, I guess, Tokyo session characteristics. Action isn't limited to Japanese shores. Other Forex transactions are made in other financial hotspots such as Hong Kong, Singapore, Sydney. The main market participants during the Tokyo sessions are commercial companies, exporters and central banks. Main market participants during Tokyo sessions are commercial exporters and central banks. Remember, Japan's economy is heavily export dependent. It's heavily export dependent. And with China also being a major trade player, there are lots of transactions taking place on a daily basis. Liquidity can sometimes be very thin. There will be times when trading during this period will be like fishing. Liquidity can sometimes be very thin. Might have to wait a long time before something happens. It is more likely you'll see stronger moves in Asia Pacific currency pairs. So likely to see stronger moves in Asia Pacific pairs such as the AUD/USD rather than non-Asia Pacific pairs such as the GBP/USD. During these times of thin liquidity, most pairs may stick within a range. This provides opportunity for short-term day traders or potential breakout trades later in the day. During time, most pairs may stick within a range. During times of thin liquidity, most pairs may stick within a range. Most of the action takes place early in the session when more economic data is released. So most of the action takes place early in the session when more economic data is released. Moves in the Tokyo session could set the tone for the rest of the day. Moves in the Tokyo session may set the tone for the rest of trading day. Traders in latter session will look at what happens during the Tokyo session to help organize and evaluate what strategies to take in other sessions. We'll look at what happens in the Tokyo session to help organize and evaluate what strategies to take in other sessions. Typically after big moves in the preceding New York session, you may see consolidation during the Tokyo session. After seeing big moves in the preceding New York session, you may see consolidation in the Tokyo session. Which pairs should you trade? Since the Tokyo session is when news from Australia, New Zealand, Japan comes out, this presents a good opportunity to trade news events. Also, there could be more movement in yen pairs as a lot of yen and is changing hands as Japanese companies are conducting business. News events since the Tokyo session, good opportunity to trade news events as Tokyo session is when news from Australia, New Zealand and Japan comes up. as Tokyo session is when news comes out. Also, there could be more movement in yen pairs as lots of yen changing hands. A lot of movement yen pairs. Take note that China is also an economic superpower, so whenever news comes out from China, it tends to lead volatile moves. News regarding China also tends to create volatile with Australia and Japan relying heavily on Chinese demand. We could see greater movement in AUD and JPY pairs when Chinese data comes in. Australia and Japan relying heavily on Chinese demand. Could see greater movement in AUD and JPY pairs when Chinese data comes in. Now let's check out how we can trade the London session. Okay, so a lot of movement. Tends to create volatile moves with Australia, Japan, and demand. Could see greater movement when China data. A lot of movement yen pairs. As let me just write. As Japanese companies are conducting business. Okay, that's the Tokyo session done. I'm going to leave this episode here. So in the next video we're going to be doing when can you trade Forex for the London session. So yeah, thank you guys for watching this episode, and I'll see you guys in the next one. Peace.